Why am I not trading NFP? One of the biggest events in the market, aside of CPI interest rate, it's undeniable a lot of traders just seem to trade NFP every given time, despite of everyone knowing that it's one of the biggest news events and it is absolutely risky to trade it, and it is historically blowing up accounts. There was a trade taken overnight with this analysis, of course. This analysis was actually also shared in my Telegram, which you guys can join also. I got the link in the bio, so just make sure to click the link and you guys can join the Telegram where I'm sharing all of these important updates of the market, just as this live trade of the gold, taking a buying trend on gold and making some decent profits. I mean, at least a 2% profit before the NFP, because of course, as the NFP event is arriving and the closer we get to the NFP, if you have any running trades, at least an hour before or 2 hours before, you do prefer closing the trade. And there are actually some very detailed reasons of why you want to completely stay away from the NFP. NFP itself is historically known to be one of the biggest events in the entire economical calendar. CPI is also considered very high impact news. Interest rate just as well also considered very high impact news. But NFP is certainly one of the news events that is notorious of being the biggest account blower for retail traders. One of the biggest reason I do want to prefer closing the trade is really the effect that I could get on trades, such as the market gaps. Like, even if this trade would be running all the way to the take profit and I would not close my trade at least an hour to 2 hours before the NFP, and let's say I would just place the trade to a break even, I am still actually putting myself at a risk of the NFP event. Because what happens if, let's suppose the NFP will be completely pushing the market to the bottom side and it will just completely make a massive impulsive move. Even if my stop loss is at a break even, and even if I'm trading with the best market execution broker in the planet, I am actually still putting myself at the risk of potential slippage due to the counterparty on the other side of the NFP simply not exactly matching with my trade. So I do know that the broker I'm using is completely no market manipulations. However, still, despite of a broker that you might be using that doesn't have any market manipulations, the market itself, the actual market itself, is still potentially causing some problems with sudden movements and of course market gaps which could potentially lead to some platform issues and also platform system breakdowns. So a lot of issues just come from even getting near the NFP event. And not just speaking of NFP event, but speaking of any given news event, like even the CPI, which is another high impact news, or interest rate, all of the major news events. If you get near those events, you're every single time at the risk of having a market gap slipping your trade. And why would a potential slippage cause me a problem on this trade even if I'm at a break even? How is it possible that a potential downward movement from NFP is causing a slippage? Even if the trade is placed at break even, if the market happens to gap over my stop loss and the actual price reopening after the NFP data is being published, if the price difference is so big, so for example, if the price difference is completely dropping all the way here to the bottom with a massive market gap of the entire market just repricing suddenly, in that case my trade will automatically of course open and be triggered at this new lower price. If for example a massive market gap would be reopening a new candle here on the bottom, such candle here. And despite having a gap here, I mean, especially having a gap here, it opens the entire position and it closes the entire position at a completely different price. And thinking that the initial break even would have been saving you from losing, you're at a massive risk of not only losing on the trade like 1 to 2% of whatever you might be risking, but who knows what, you might be entirely blowing up your entire account. So that's another thing why, of course, it's gonna be pretty important to stay away from this news event. And as I mentioned a moment ago, if you have any sort of running trades that is profitable, you will just want to make sure you're definitely closing it 1 to 2 hours before the market is publishing the NFP. And of course, all of these examples I have given and all of the reasons why I will stay away from it, these are mostly for real market execution brokers, which we only have a very few of, but in real market conditions. And I haven't even mentioned what if you're using a market maker broker, which is of course what most brokers are doing. Like the good 90% of the brokerage industry, they are just running B books and they are just a market maker. So you also have to count with the fact that the broker might be not only just putting you in a position where the trade might be slipped from the market conditions itself, but also your trade might be intentionally manipulated. Because all of these B-book brokerages, they are especially taking advantage of all of these high impact news events, because if they are going to be adding any sort of market manipulation artificially, you're not going to be noticing it. So we are speaking of any type of sudden spikes in the market or any type of artificial trade latency when you open the trade. And let's say you open the trade might be closing only after a much longer time. So all of these artificial manipulations are also putting yourself at a risk. I won't be naming specific brokers of which one is B-book and which one isn't right now. But what I'm gonna tell you is at least the good 90% is indeed B-book, and you're definitely putting yourself at risk. So it's really a non-negotiable factor in trading. Like, you just gotta stay away from all of these news events. You're not even benefiting anything from it. Like, thinking that one sudden large win is going to be benefiting you in any regard is absolutely wrong. And it's just something you do not want to do. Hey guys, how's it going? Welcome back to the YouTube. I have received quite a few questions from my last recording on NFP when I mentioned slippage, of how the slippage is working. I did indeed mention that slippage is going to be causing a lot of risk to your trades, and of course, when you're having the news event, you want to avoid it to avoid the risk of slippage. So, after receiving quite a few questions of how the slippage is working and some more detailed explanation on it, I decided to make a brief recording and explain some details here. So, what is slippage and how is it going to be working? Slippage, as a brief statement, slippage is requesting a market execution at a certain price when you're pressing the button, and getting the trade executed at a different price when the trade actually gets executed. So is the difference between the actual price you're expecting to execute the trade on instead of the actual price the market fills your order in. So that happens a few times, of course. It's definitely experienced, especially if you ever traded a live account, not just the prop firm demo accounts, because mostly anything that's a prop trading evaluation, you will not really face any slippage due to the nature of the demo nature of the account. However, if you're trading anything that's a live trading account, you of course probably experience slippage at some time in your career. So let's see some details here. And some further explanation of what this is. Whenever you're trading and whenever you're executing a position, any type of order you're placing, there's a counterparty on the other side every single time. If you would be buying a one lot position at a given moment, on the other side there's going to be a counterparty every time who's selling one lot trading volume at that given moment, probably at the same time, and your position is technically having a counterparty against it, because that's of course how the over the counter market is working. So the OTC market, which is the standard nature of the forex industry, is you're having a counterparty against you. And you shall imagine the market as each of the price levels are executed by different traders with different trading volumes in terms of different type of lot sizes. And in normal cases, when you're not having any type of slippage, when you press the button to execute a position, your trade is connected to a different counterparty, or the other counterparty is taking a selling position at the same time with the same volume, of course. And if it happens to be the same volume and your position happens to be having a valid counterparty on this other side who the order can be filled against in, your trade is going to be accepted at the requested price. And of course your trade is not going to be facing any sort of slippage, because the counterparty on the other side is of course going to be filling in the trade against you on the same price level. So, technically imagine when you're selling, someone else is buying the same trade at the same price. So in that case, if that happens, there won't be any sort of slippage. And in other cases, when you're facing a slippage, the way that would happen is if you request the order at a given price, let's say a 10 lot buying position, and if there isn't enough counterparty on the other side to cover the position, to compensate the position on the selling side, of course, your order isn't going to be executed at your own requested market price. So that being said, of course, if someone is having a 10 lot position at a different price, it is going to be executed more on the different price and the difference between the average ratio of those two prices. So let's just take an illustrative example of this, of how this is going to be working. Alright, so now that we are here on TradingView, let's just take an illustrative example of how the non-slippage market situation would be working. So let's imagine a situation where you would be expecting to take a buying position at a certain price in the market with a one lot position, and if that's the case, and at that given moment there's also another counterparty on the other side who's selling a one lot position, your trade is of course going to be executed at the same price in the market as you were expecting to be executing the trade at. So technically there won't be any slippage, and the counterparty who's also selling one lot position, when you're taking that buying trade that is one lot position, their counterparty is matched and you're not facing any slippage. But let's suppose things would be a bit different, and let's say you would be opening a much higher volume position with a 7 lot trade, and let's say there's a different 7 lot order at a different price, but there wouldn't be any sort of volumes on the prices in between. Your order is of course going to be accepted at a worse price, because let's suppose a different selling position is going to be at a different price in the market. The same order has to be matched up with a different counterparty, and in that case your trade is going to be affected with the slippage, because your original requested market price is just not going to be accepted at the requested price, and of course that is creating the slippage that you're facing on a trade. So let's take this as a further another example here. Suppose that the order that you're placing is going to be having a 7 lot position, and at your requested market price the counterparty that the market is finding against you is only going to be a 1 lot position. Of course, if that's the case, the 7 lot order cannot be executed at the initial requested price either, and if at a different price level the market isn't going to be having any sort of 7 lot position either. So while on the previous example we had a 7 lot position on a different price level at a counterparty, if that wouldn't be the case, that none of the recent other prices is matching up your order, the trade is going to be, of course, automatically split up into multiple positions, and your trade is going to be filling the possible values, of course, of the possible counterparties, and each of the volumes that's available as a point of liquidity. So any of the available counterparties is of course going to be used up by your position, and an average value of this position is going to be the result of the slippage. So in that case, because the market wasn't finding any sort of other counterparty at any given price, the position is going to be split up into different pieces, and that would be resulting in an average number of these positions and the average value of the price, creating an execution price of a different price once again. So in this case, there would have been a 1.8 pip slippage with this example, but once again it does show how the order will be matching up the slippage and how the order will be matching up your price with a different trader's counterparty's order. So that of course is creating the slippage. And how is this tying all the way back to that other NFP example that I have spoke of last week or in the last meeting? Is whenever you're having a position, let's say on the news event, you're going to be facing the slippage issues because the market just isn't able to find enough liquidity at the requested market price on a counterparty against your trade. So that being said, of course, your position is going to be split up into multiple orders and executed at the available other prices. And as a quick summary, how would this be affecting your trades in real time, and how do you manage this? Well, there's a couple of ways to manage it, and of course it kind of depends first in the first place, like, are you trading a demo evaluation on a prop trading firm, or are you trading on a live account with a brokerage? What you gotta know is evaluation firms challenges are of course going to be done on a demo account, so you're not even facing any problems with slippage, and you shouldn't be facing any problems. Like some very low tier companies, I do know they do have some artificial slippage, but in a demo environment you should not be having any sort of slippage in the first place. So on the evaluation or the challenge, you are not even having any problems with this. But how do you manage this if you're trading a live account? Because of course on a live account you would be placed in a real environment, and before I speak of some details of the live account, understanding that if you're actually trading on a prop firm that's giving you funding, this also bears the question that, okay, if you're trading on a demo account and the company that's copying your trades to give you funding, if they are copying your trades to their own live account, if they face slippage on their positions but you do not face slippage because you're executing on a demo account, that can kind of affect your trade. So in that case you might want to reconsider probably not trading on high impact news events, because that also does answer the question why some companies do not allow the news trading. Because of course if you're taking a position on a demo account and on a news event, you're not facing any slippage, but as the company is copying your trade, they might be facing slippage on the live markets because, like I mentioned, slippage is indeed a natural process of the market in some certain cases. So you gotta avoid news trading events to save yourself from this. And of course, if you're getting funded, it's just completely bad for the funding firm to have trades that are affected by the slippage because of course they are not getting the same positions as you're getting on your demo account. So just kind of try to avoid it. So that's the prop trading side. And as a quick summary, so on the prop trading side, the client doesn't really face any problems with it because it's a demo, but if the company is copying your trade, they might have to deal with it. So on the live account side, let's say you're having a live account, absolutely your own personal funds, your own personal trading account with a brokerage. If the broker is B-booking you, which I can absolutely tell you a good 90% of the brokerages, they are indeed going to be B-booking you because that's what the 90% of the brokerage industry is. It is just simply running traders on a B-book. A very few companies on the brokerage industry, they do A-book everything. The broker I'm using is A-book. Otherwise, if you're making long-term profits, you're kind of facing issues with a B-book broker because they always try to mess with your trades. So in that case, you might not be facing any problems with it, but like I mentioned, you might be having some artificial slippage. But if you're having an A-book brokerage, like a full-on A-book broker that's absolutely sending all of your trades to the real markets, which you should be using if you're, of course, serious in your trading. So if you're using an A-book brokerage, you should try to avoid trading like absolutely too big trading volumes. Like we are speaking of 100 lot or hundreds of lots or 1,000 lots. So obviously it's a pretty extreme example, and you do need a substantial capital to reach that position sizing to even face a problem with this. But even with smaller positions, like if you're having a 10 lot position, very often if you just want to make sure that your position is getting executed at the best possible prices, if you're opening a 10 lot volume position, it's sometimes better to be layering those trades into like 10 pieces of 1 lot positions. So it's also possible to layer some of your positions. That way you would be facing less of a slippage. But the higher the volume you go, the higher volume you're using in your trades, the more it's kind of possible to have some slippage. And on the other hand, most brokers actually they do limit the lot sizes. So if they limit your lot sizes to maximum 200 lots or 200 lots, for example, as the max volume, like that's also limited for the purpose to avoid too much slippage on the client side. So it's working that way, and as the solution, you just kind of gotta make sure to open multiple smaller positions instead of one massive trade. So let's say not opening 100 lot trade, you would be opening like 5 20 lot trades, for example, and it does indeed layer some of those positions into a much better market pricing.